What's up, everybody? Welcome to another episode of China Update, where I help you guys keep on top of the world's #2 economy. My name is Tony, and it's great to see you guys again. For anyone who's new, I'm a lawyer by training, but I came to China and I studied Chinese foreign policy and economics. I now work in an executive role, and part of my responsibilities include following big macro developments coming out of China. And on Friday nights, I would sit down with my mates and talk about the sort of stuff that was happening in China that week and what I thought they should know. And they said, man, you should chuck that stuff up on YouTube. And I thought, what the hell, why not? So if you're interested in China and following the sort of developments that are coming out of this crazy, interesting place, the world's #2 economy, and you think this might be something you're interested in, maybe consider subscribing. If you think this video is decent or you like what you see, don't forget to smash that like button. It is a massive, massive help for new YouTubers like myself. It really helps with the YouTube algorithm and getting that video out there. So without further ado, let's jump into this episode. The last few weeks, we've been talking a lot about Hong Kong. That's been very, very important. There's been a lot of political, social, economic developments coming out of the SAR region down there. This week, we need to talk about Hong Kong as well, but that's going to be the second story. First story, we need to talk about the trade deal that was signed this week. This is the biggest news of the week, I think. So let's talk about that first. So on Thursday, it was announced that Trump was going to accept the trade deal. This was agreed in principle. The Phase 1 trade agreement was agreed in principle a few months ago, but there was some debate as to whether it was going to get across the line because there were still a couple of aspects of the agreement that were not agreed upon yet. This Sunday, the 15th of December in the US, represented a very important date. This was when a tranche of tariffs was going to be introduced to 160 billion in Chinese goods. So there was some debate as to whether those tariffs were going to go into place if they could not reach an agreement this week. That point is now a moot point because the agreement did get across the line and we finally know what the details are going to be. The two contentious parts of the agreement leading up to this were, one, how much the Chinese were going to purchase in agricultural products from the United States, and two, whether the White House was going to roll back the tariffs that have already been on Chinese goods since the trade war began in April of last year. So what did the Chinese agree to? There are three main parts of this agreement that we need to know here. One is a significant increase in the amount of goods they're going to purchase from the United States, and a big part of that has been earmarked for agricultural purchases. Two, to liberalize and open up their financial sector and allow for more American investment into the system and control over entities that they invest into. And three, to implement stronger intellectual property protection for American companies operating in China. So what did the Americans agree to? Well, the American side has said that it will not impose tariffs on the 15th. In fact, it's going to cancel those planned tariffs completely, and they are going to roll back existing tariffs. We do not know at this point how much of a rollback we're going to see. I think it's very, very, very unlikely that all the tariffs are going to be rolled back. I think you're going to see a moderate reduction in the existing tariffs. I'm sure both sides have agreed to exactly what they want to roll back. The Americans will be keen, I think, to roll back tariffs on consumer electronics and products that are popular amongst American consumers, because these sort of tariffs are politically popular. But the tariffs that were originally erected against like manufacturing and steel are probably going to remain in place. The US Trade Representative, Lighthouser, had said that the reason that they wanted to hold some tariffs on China was as a way of ensuring that the Chinese side lived up to these IP and financial sector liberalization promises they had made. So this is sort of a way of ensuring that happens. But there has been an agreement that there will be some modest rollback to existing American tariffs. So the increase in purchases that the Chinese agreed to is very, very interesting. It has been reported that the Chinese have agreed to purchase an extra 200 billion USD in products over the next few years. These are made up primarily of agricultural products, manufacturing products, and energy products. These are the three big ones, along with services. The biggest of these three will be agricultural products. This was a very important part of the deal for Trump. He recognizes the agribusiness purchases tied to his base. It's going to be very important going to an election year, having the farmers happy. Now, this 50 billion over 2 years is quite a high number. Trump had actually indicated in a press conference over a month ago that that is the number that he wanted. The Chinese said pre-tariff levels, which were 20 billion. The agricultural sector had actually taken a big hit with the trade war. The level of Chinese purchases of American agricultural products were about 20 billion before the trade war. 12 months in, the end of last year, beginning of this year, that dropped to about 9 billion. So over 50% reduction in purchases from the Chinese side. So I think a lot of American farmers will be very pleased about this. Okay, so what has the reaction been? So it's been pretty positive in the market. The US stock market has performed very well over the last day or so. It is now at historically high levels, and the RMB has also jumped in value. It is now below that threshold of 7 USD. But what does this agreement mean in the long run? Well, I think not too much. You have to remember that this deal was sort of a short-term to medium-term win or breather that the Chinese and the American side needed. The Trump administration had reasons, they had their own reasons to get an agreement across the line. The Chinese side also needed a break from this trade war so they can deal with some of their internal issues and some of the other external issues going into 2020. I've said before that this phase 1 trade agreement deals primarily with the low-hanging fruit in the relationship and deals with concerns that Trump has dealing with things like trade deficit, but doesn't deal with the wider concern amongst the American business community about structural reforms that need to happen in China. That stuff hasn't been touched. Now, the Trump administration has said that is going to be discussed in the second phase of the agreement. I don't think that is going to go anywhere. As for now, both sides have their face. They can turn towards their domestic issues. The Trump administration obviously has its own domestic issues at the moment, as I'm sure you know, and it's going into an election year. The Chinese have internal issues that they're also trying to deal with. This wider trade dispute is going to continue, and I think it's going to be the new normal, and it is very, very unlikely that you're going to see a large, comprehensive trade deal that's concluded within the next couple of years. It's also worth noting before we go on that the American side actually had a very, very strong position going into these talks. A lot of the data that has come out shows that over the last year, the trade deficit between the two countries has actually reduced by about 1/3. And it seems that the Chinese side has taken a much bigger hit in terms of the trade war and the effect it's had on export numbers in the American side. In fact, the October numbers are very telling. Year on year, the Chinese saw a reduction of about 25% in their exports to the United States. What about the United States to China? Only about 3%. And actually, last month in November, the American side, their imports to China increased. So this does indicate that the Americans do have a slightly stronger hand in these negotiations and will continue going forward if they choose to put on the pressure again with tariffs if it gets to that point. We also need to keep in mind that there is a very strong anti-China bipartisan feeling on the Hill in Congress. Even if Trump is able to form a solid trade relationship with the Chinese, I think you're going to see a Congress that continues to pass laws, despite what's coming out of the White House, protecting the American economy from the Chinese side and other laws like that. Okay, let's talk about Hong Kong. There are a few little things that we need to talk about. There hasn't been any major escalations in the last few weeks since the Pan-Democrats had their big win in the local elections, but there's a few things we need to touch on. The first is last Sunday, there was a pretty big, relatively peaceful protest. The police put the numbers about 200,000, the organizers said about 800,000, so hundreds of thousands participated. The Hong Kong police disarmed 2 homemade bombs earlier in the week as well, 2 different locations, which is concerning, but there was no explosion, no injuries with that. On Wednesday, the Chinese Vice Minister of Foreign Affairs, Ma Jiaxiu, said in an official statement that it is his belief that the American side is trying to achieve regime change in China through promoting color revolutions in Hong Kong. So very strong statement coming out from the Foreign Ministry on Wednesday. Also, Chairman Xi Jinping is set to travel to Macau next week to celebrate the 20-year anniversary of the passing back of Macau to mainland China. Now, Macau is actually very similar to Hong Kong. It's a special administrative region. It operates with a high level of autonomy like Hong Kong under the 一国两制, or one country, two systems policy. And it was handed back to the Chinese side in 1999, 2 years after the Hong Kong handover in 97. Hong Kong was a former British colony and Macau was a former colony of Portugal, and actually much, much older than Hong Kong as a colonial holding. Now, Reuters had a very interesting exclusive story this week where they said that Chinese officials had said that Xi Jinping was going to announce a slew of policy reforms in Macau that would open up the financial system and allow for the creation of a financial hub. The Chinese government is trying to hedge their bets by bringing some of that financial center over to the Macau side. Now, the government does have a lot of power to push Chinese capital from Chinese companies into Macau and bring some of that financial center of gravity over to Macau. But in terms of convincing international capital, that's another story. This is also assuming that there is a peaceful resolution in Hong Kong and isn't a major financial crisis. And there's still a big question mark around that. Now, speaking of the economy, let's go back to Hong Kong and look at the economic situation. We've already discussed in the last few episodes some of the bigger macroeconomic issues that Hong Kong is facing: the risk of recession, financial pressure, over leverage, drops in all sorts of economic indicators for performance. Let's look specifically at the retail sector, because this is taking a particularly bad hit. Tourist numbers are down 50% last month, which is the worst performance Hong Kong has had since 2003, when there was a SARS outbreak. The retail reduction in retail spending is the lowest on record. Records began, I think, in 81 and has never seen a drop of this much, 24% last month. Now, the Hong Kong Retail Management Association actually did a big survey where they surveyed businesses that operate thousands of stores in Hong Kong, and the report they got back was quite concerning. They discovered that 7,000 retailers are going to shut down in the next 6 months. 97% of retailers have had major losses. So this is a big part of the Hong Kong economy, and it's driven a lot by retail spending from tourists, and those numbers are down. This is going to have a big effect on public opinion in the longer run and could cause attrition on the ground, because this affects a lot of small business people, affects employment, people who have jobs in these sectors. So this sort of stuff is stuff we need to be aware of as well. The economic conditions on the ground and how it affects the wider public, because that will have a direct effect on public opinion, and public opinion is central to these wider protest movements in Hong Kong. Okay, next we need to talk about the Central Economic Work Conference, which was held this week in Beijing. As of filming of this, it is finished. This is a closed-door meeting among some of the leadership in the country where they discuss the economic goals for the following year. They set things like their growth targets, inflation range, the size of the deficit, so the fiscal deficit, things like that. They do not release these specific targets until after the Liang Hui, or the 2 sessions meeting, which happens in March of the following year, so March of 2020 for this one. But they did make a statement. This is going to be a particularly sensitive meeting this year, I think. When you look at the reduction in growth in the economy, the level of inflation, which is at an 8-year high, though this is being driven primarily by pork prices, not overall inflation. I'm sure they've got some sensitive issues to discuss this year. The statement's interesting because it mentions a few things. Let's go through these one at a time. It mentions that the Chinese economy is facing serious structural issues, and this is a challenge that needs to be overcome. It also recognizes that there are external or global trends or phenomena that are having a negative effect on the Chinese economy. This could be reference to the trade war, but also about wider slowdown and instability in the region. The statement also identifies 3 tough battles. This language is very interesting because it identifies the 3 broad policy areas that the government is most concerned about tackling over the next year or so and in the longer term. The first is major risks, and here it means economic risks, whether it's talking about inflation through lack of food supply, the property market bubble, over leverage, issues with financing at the local level, or external issues like the trade war. This is the first of the 3 challenges. The second is poverty reduction. Now, this is important ideologically. I mean, it's the Communist Party, so the idea of equality and the cake being shared for everyone. This is still politically and ideologically an important concept. Specifically here, they're not so much talking about poverty reduction, though that is important, but wealth inequality and the social and political challenges that wealth inequality introduces. And so this is the second and the third tough battles. And the third is pollution. So this pollution is not just talking about air pollution, it's also talking about soil pollution and water pollution. These 2 areas are actually far more serious and acute. We see in the West a lot of stories about air pollution in China, but actually that is nothing compared to soil and water issues. I would say that water issues, water supply and waterway pollution is the most serious issue the Chinese are facing over the next 20 to 30 years. It is the big one. 20 years ago, China had 50,000 rivers. As of last year, that number was 22,000. In terms of water supply and the size of the basin, that would be equivalent to the United States losing the entire Mississippi River. Beijing, which has a massive population in the north, relies on 70% of its drinkable water being transported, being pumped from the south over 2,000 kilometers away. And even though Beijing gets 70% of its water from the south, its water level per capita is still less than 1/6 the minimum level that is recognized internationally for defining an area from suffering from water scarcity. And Beijing has a population equivalent to the size of Australia, and that's how scarce the water is up there. Finally, the statement talks about housing speculation. In the statement, they actually say, homes are for living, not for speculation. And on that, I want to discuss a very concerning document that was released by an academic institution within China itself. So this institution is called the China Household Finance Survey and Research Center. It is a reputable institution that was set up through private funding and from universities in China, and is highly respected for the information that they provide on consumer spending, and specifically consumer spending on housing and housing trends. They released an interesting report this week on Chinese household debt as a percentage of their disposable income. So the report introduces an alternative way of measuring this ratio, debt to disposable income. That's basically how much does a household owe on average compared to how much it earns after taxes and expenses. That's what we're talking about here. That ratio up until now was an incredibly high 120%. Chinese household debt on average was equivalent to 120% of disposable income on an annual basis. This report said that it's actually a little bit lower. That number comes from the National Bureau of Statistics in Beijing. They said the number is actually closer to 22%, but this is still a very, very high number. Now, it's important that we use comparisons here so you get an idea of what this actually means. Put that in perspective, this ratio in the United States in 08-09 during the financial crisis was 116%. Okay, within a few years that dropped to 100%, and as of last year, the US debt to disposable income ratio was 86%. That had been flat for about 5 years. The Chinese is between 92 and 120%. It has been rising, no matter what metric you use, the former or the latter, it has been rising by about 8% per annum. So Chinese debt to disposable income is rapidly increasing, and that is being fueled by the property market. Most of the debt that Chinese households are taking on is coming from buying properties. The most concerning statistic from this report, however, is 66% of new home loans are being used to purchase second or third homes. This suggests that the housing market is being fueled by speculation. You have very high levels of household debt in China, and it seems like that debt is in housing, which is increasing in value primarily through housing speculation. So this is incredibly concerning for the central government, and is exactly why they discussed this specifically in this economic conference report that concluded this week. Okay guys, 2 more quick stories. We need to talk about the technical default of a local government financing vehicle in Inner Mongolia that happened this week. This is also something that's quite concerning. Let me quickly explain what a local government financing vehicle is. Basically, local governments, they have targets for economic growth that are set by the central government. They typically achieve growth by investing in infrastructure, but the central government also puts a limit on how leveraged the local government can be. So in order to get around this, they set up a separate legal entity, a company, which can get finances through the selling of bonds, so they can raise the capital from investors necessary to invest in infrastructure projects. This ensures that the local government officials meet their growth targets, and they also don't break the rules when it comes to how much local governments can borrow. Now, there are a few issues with this. One, local governments have been addicted to debt for many, many years, and now debt levels are very, very high, even though they're technically in these local government financing vehicles and not directly held by the local government or the state. Two, because of moral hazard, basically the idea that investors believe that these financing vehicles cannot default because they're backed by the state, a lot of investors have bought bonds without thinking about the relative risk. And so it means there's a lot of money in this bond market. It is now over $1 trillion. So Inner Mongolia has had economic issues over the last few years. This is not new to anyone, but people still lent to these local government financing vehicles because they believed they were implicitly backed by the local government. The fact that this vehicle was unable to pay a bond payment on time is a very strong signal to investors that maybe they can't trust in this anymore, and they should consider risk and balancing risk when they purchase bonds from some of these instruments. Now, it was a technical default, not a true default. They actually made the payment after a few days. There is a grace period in China of about 10 days for making bond payments. But this was also hot off the heels of another late payment that was made by a similar financing vehicle in Xinjiang, I think last week or the week before last. So I do think the government is sending out a signal to investors that maybe these things are not 100% safe like you thought. At the same time, they're sort of playing with fire here because there is a lot of rot with these instruments. They're a very, very opaque way of financing local government projects. This entire area has a lot of bodies in the wardrobe, as it were. So I think the government wants to take it slow when it comes to deleveraging or dealing with this issue of debt at the local level and clearing out some of these poor performing local financing vehicles. Because once they start pulling out the rotten floorboards, there's a risk that the whole thing might fall in. Okay guys, last story. Finally, we have a technology story, and this is part of the wider topic of the potential technology decoupling China and the US, or China the West, or China and the world may be going through. So this week, Beijing ordered all government bodies, institutions, whatever, to remove all foreign computer equipment. Now, China Securities, which is a brokerage, estimates this to be about 20 to 30 million computer devices that need to be removed over the next 3 years. So this is no small decision to make. The Chinese have set up a large subsidy program to subsidize Chinese companies within China so then they can produce extra equipment and meet the demand that's going to exist now in China. The reason why this is an interesting development for me is I think it is one step in a series of steps that have been taken from China to remove themselves or decouple technology-wise from the outside world. There's been some debate recently about whether the US and China are going to decouple in technology, especially with the Huawei debate raging at the moment. But to be honest, this decoupling started a long time ago. The Chinese have had a separate internet. Later on, they banned major tech companies, particularly American tech companies, from operating within the market. They set up subsidy programs to grow homegrown technology companies that are now performing very, very well. So foreign hardware is being removed, and this is just the start. I would not be surprised if in the near future we see a time where the Chinese ban Apple and Android OS systems from being sold on phones within China. So I think this is another sign that China and the rest of the world, specifically China and the United States, are decoupling in that technology realm and going separate ways. Well, I hope you guys enjoyed the episode today. That was a heavy economics episode, but hope you liked it. I'll see you guys next week. Don't forget to smash that like button, and if you're interested in this sort of stuff, consider subscribing. Okay guys, see you next time.